What if the biggest mistake beginner investors make is not buying the wrong stock? What if the biggest mistake is investing before they understand money itself? Because here is the truth most people only learn after losing money. Investing is not the first step to becoming wealthy. Investing is the amplifier. It multiplies what you already know, what you already practice, and what you already control. If your money habits are strong, investing can help you build wealth over time. But if your money habits are weak, investing can expose every weakness faster than you expected. That is why some people buy their first stock, panic when it drops, sell at the worst time, and then say, investing is a scam. While another person buys patiently, stays calm, keeps learning, and slowly builds a portfolio that grows for years. The difference is not luck. The difference is skill. And before you invest, there are 5 money skills every beginner must learn. Not complicated Wall Street skills. Not advanced trading strategies. Not secret millionaire tricks. Simple, powerful, foundational money skills. The kind of skills that protect you when prices rise. The kind of skills that keep you calm when markets fall. The kind of skills that help you avoid debt traps, emotional investing, and financial pressure. And in today's economy, these skills matter more than ever. Because interest rates, inflation, energy prices, global uncertainty, and market volatility are not just headlines. They affect rent. They affect groceries. They affect debt payments. They affect savings. They affect how investors behave. And if you do not understand how money works in your own life, the stock market can feel like a casino instead of a wealth-building tool. So before you buy stocks, crypto, ETFs, real estate, or any other asset, master these 5 money skills first. Welcome to Capital Academy. This is where we make money, investing, and wealth building simple enough for beginners to understand, but serious enough to actually change your financial life. Today's episode is called, Don't Invest Until You Master These 5 Money Skills. Let's begin with something nobody likes to admit. Most people do not have an investing problem. They have a money management problem. They want to know which stock to buy. They want to know which asset will explode next. They want to know how to make passive income. But they cannot clearly answer one simple question. Where does your money go every month? That brings us to money skill number 1. The first skill is cash flow control. Cash flow simply means money coming in and money going out. Income comes in, expenses go out, and whatever is left becomes your financial power. If nothing is left, it does not matter how many investing videos you watch. You cannot build wealth consistently if every dollar disappears before the month ends. This is why personal finance always begins with awareness. Not shame, not guilt, awareness. Imagine 2 beginners. Both earn the same amount. Both want to start investing. The first person gets paid, spends randomly, taps their card without thinking, subscribes to services they forgot about, eats out more than they planned, and then wonders why they are broke 3 days before payday. The second person gets paid, checks their bills, sets money aside, limits unnecessary spending, and knows exactly how much they can invest without panic. Same income, different skill. One is controlled by money. The other controls money. This is the foundation of investing. Because investing requires consistency, and consistency requires surplus. A surplus is the money left over after your life is paid for. If you do not create a surplus, you will constantly be forced to interrupt your investing journey. You will invest 1 month, stop the next month, withdraw during emergencies, restart later, and never build momentum. In the history of personal finance, this idea is not new. Long before investing apps, credit cards, and online banking, households still had to manage resources. Ancient merchants kept written records of grain, silver, debts, and trade. Farmers planned harvests around seasons. Families tracked what they had, what they owed, and what they needed to survive. The tools have changed. The principle has not. You cannot manage what you do not measure. Today, that might mean using a budgeting app. It might mean using a spreadsheet. It might mean writing everything in a notebook. The tool does not matter. The habit matters. For 1 month, track every dollar. Not because you want to punish yourself, because you want to see the truth. How much goes to rent? How much goes to transport? How much goes to food? How much goes to debt? How much goes to impulse spending? How much disappears into small purchases that feel harmless individually, but become expensive together? This is where many beginners get shocked. They think their biggest problem is a lack of investing knowledge. But then they discover they are leaking money every month. A little here, a little there, a forgotten subscription, a random delivery order, a purchase made out of boredom, a purchase made to impress people, a purchase made because social media made it feel normal. Modern personal finance culture is heavily shaped by lifestyle pressure. People compare their private bank account to someone else's public highlight reel. They see vacations, cars, designer clothes, trading screenshots, luxury apartments, and motivational quotes about wealth. Then they spend money to feel like they are not falling behind. But real wealth often looks boring in the beginning. It looks like knowing your numbers. It looks like saying no. It looks like delaying purchases. It looks like having money left over when nobody is clapping for you. And that is why cash flow control is the first skill. Before you ask, what should I invest in? Ask, how much can I consistently invest without hurting my basic life? Because the investor who can invest $50 every month calmly may do better over time than the person who invests $500 once, panics, and quits. Money skill number 2 is saving before investing. This may sound strange, because investing content often makes saving sound boring. People say cash loses value to inflation, and that can be true. When prices rise, cash can lose purchasing power. But that does not mean beginners should invest every dollar they have. Cash has a job. The job of cash is not to make you rich. The job of cash is to protect you from being forced to make desperate financial decisions. This is why an emergency fund matters. An emergency fund is money set aside for unexpected life events. A job loss, a medical bill, a family emergency, a broken phone, a car repair, a sudden move, a business slowdown, or anything that arrives without asking for permission. Without savings, every emergency becomes a crisis. And when every emergency becomes a crisis, you may be forced to sell investments at the wrong time. This is one of the most painful beginner mistakes. Someone invests money they might need soon. The market drops. Then life happens. They need cash. So they sell while the investment is down. Then they walk away thinking investing made them lose money. But the real issue was not only the market. The real issue was investing money that should have been kept safe. History has taught this lesson again and again. During market crashes, the people most likely to survive financially are usually the ones with liquidity. Liquidity means access to cash. During the Great Depression, the 2008 financial crisis, the pandemic crash, and every major panic, cash gave people options. Cash gave them time. Cash gave them the ability to avoid selling everything in fear. This does not mean holding all your money in cash forever. It means building a protective layer before taking investment risk. For many beginners, a good starting target is 1 month of essential expenses, then 3 months. Then, depending on your life situation, 6 months or more. A student living with family may need less. A parent with children may need more. A freelancer with a regular income may need more. Someone with a stable job and low expenses may build gradually. The point is not perfection. The point is protection. And in a world where inflation, interest rates, and economic uncertainty can change quickly, protection becomes powerful. When central banks talk about inflation, interest rates, and economic growth, it may sound distant. But those decisions can affect your real life. Higher interest rates can make loans more expensive. Inflation can make groceries, fuel, rent, and services cost more. Slower economic growth can affect jobs and business income. So when the economy becomes uncertain, your personal safety margin matters. Savings are your first safety margin. Before you become an investor, become financially stable enough to stay invested. Because the market rewards patience. But patience is easier when you are not one emergency away from panic. Money skill number 3 is debt control. Debt is one of the most important money skills because debt can either be a tool or a trap. And for beginners, it is often the trap that comes first. Debt means borrowing money today and paying it back later. But the hidden force inside debt is interest. Interest is the cost of borrowing money. When you invest, interest and returns can work for you. When you borrow badly, interest works against you. This is why debt can quietly destroy financial progress. You might invest and earn a return. But if you are paying high interest on consumer debt, your money may be moving backward faster than your investments can move forward. Imagine trying to fill a bucket with water while there is a hole at the bottom. Investing is the water. High-interest debt is the hole. Before you celebrate the water, fix the leak. This does not mean all debt is automatically bad. Historically, debt has helped people build businesses, buy homes, finance education, and expand economies. Governments use debt. Companies use debt. Investors use debt. But the difference is whether the debt helps create value or simply funds consumption. A business loan used carefully to buy equipment may increase income. A student loan used wisely may increase future earning power. A mortgage on an affordable home may build long-term stability. But high-interest debt used for lifestyle spending can become dangerous. Credit cards, payday loans, expensive personal loans, buy now pay later habits, and borrowing to impress people can keep beginners trapped. Modern personal finance culture makes this even more difficult. Many things are designed to feel affordable. Small monthly payments, easy approval, zero deposit offers, buy now pay later, minimum payments. The danger is that the monthly payment feels small, but the total cost becomes large. And when people focus only on the monthly payment, they stop asking the real question. How much will this cost me in total? That question can change your financial life. Because debt is not just a number. Debt is future income already promised to someone else. Every payment you owe tomorrow reduces your freedom tomorrow. And investing is about buying future freedom. So if debt is stealing your future income, investing becomes harder. The skill is not to fear debt blindly. The skill is to understand debt clearly. Know your interest rates. Know your minimum payments. Know your payoff dates. Know which debts are urgent. Know which debts are manageable. A simple method is to list every debt from highest interest rate to lowest interest rate. The highest interest debt is usually the most dangerous mathematically. Another method is to list debts from smallest balance to largest balance to build motivation. Both methods can work. The key is to stop ignoring the debt, because ignored debt grows in silence. And once you understand debt, you understand one of the most important ideas in investing history: compound interest. Compound interest is when money grows on top of money. Investors love compounding because returns can build over time, but debt can compound too. If you owe money and interest keeps adding up, compounding works against you. The same force that can build wealth can also build pressure. That is why beginners must respect interest before chasing returns. Money skill number 4 is understanding risk. This is the bridge between personal finance and investing. Most beginners hear the word risk and think it simply means losing money. But risk is deeper than that. Risk means uncertainty. Risk means the future may not happen exactly how you expect. Risk means prices can move, jobs can change, inflation can rise, businesses can fail, trends can reverse, markets can panic, and your own emotions can surprise you. The history of investing is full of people who underestimated risk. In the 1600s, the Dutch became famous for tulip mania, where tulip bulbs became wildly expensive before prices collapsed. In the 1920s, many investors believed the stock market could only go up, right before the crash of 1929. During the dot-com bubble, investors believed almost every internet company would become a giant. In the housing boom before 2008, many people believed home prices could not fall nationally. During crypto manias, meme stock rallies, and speculative bubbles, many beginners believed they had found easy money. The pattern repeats because human emotion repeats. Greed tells people, this time is different. Fear tells people, get out before you lose everything. Successful investing requires learning how to stand between greed and fear. That begins with understanding risk before you invest. A beginner should understand that different assets carry different types of risk. Cash has inflation risk. Bonds have interest rate and credit risk. Stocks have market risk and business risk. Real estate has liquidity, debt, maintenance, and location risk. Crypto has extreme volatility and regulatory uncertainty. Even doing nothing has risk, because prices can rise while your money stays still. So the goal is not to avoid all risk. The goal is to take the right amount of risk for your goals, timeline, and emotional strength. This is why time matters. Money needed next month should not be treated like money needed in 30 years. Short-term money needs safety. Long-term money can usually handle more volatility. If you are saving for rent, tuition, or an emergency, that money should not be gambled in risky assets. But if you are investing for retirement, long-term wealth, or a goal far in the future, Temporary market drops may be part of the journey. This is where many beginners struggle. They say they are long-term investors, but the first time the market drops, they behave like short-term traders. They panic. They check prices every hour. They watch scary headlines. They sell. Then when the market recovers, they buy back higher. This cycle can quietly destroy returns. Risk management is not just about picking investments. It is about preparing your mind. Ask yourself, if my investment dropped 20%, would I panic? If the market stayed flat for a year, would I quit? If everyone online was getting rich faster than me, would I abandon my plan? If headlines became scary, would I still think clearly? These questions matter because investing is not only math. Investing is behavior, and behavior is where many people lose. There is an old idea in markets. The stock market is a device for transferring money from the impatient to the patient. Whether or not someone says it in exactly those words, the principle is powerful. Patience is an advantage, but patience is built before the panic. You build patience by understanding risk. You build patience by having savings. You build patience by avoiding dangerous debt. You build patience by investing only money that belongs to the future. Money skill number 5 is building a wealth system. This is the skill that brings everything together. Most beginners think wealthy people become wealthy because they make one huge move. They imagine one perfect stock, one perfect business, one perfect investment, one lucky trade. But most wealth is built through systems. A system is a repeatable process, something you do again and again, even when motivation disappears. A wealth system might look simple. Earn money, track money, save first, pay down bad debt, keep an emergency fund, invest consistently, increase income, avoid lifestyle inflation, repeat for years. This sounds boring, but boring is often what works. In personal finance history, many of the most powerful ideas are simple. Spend less than you earn, protect against disaster, avoid destructive debt, own productive assets, let time work, teach the next generation. These principles existed long before modern finance influencers. They existed in family businesses, in farming communities, in merchant houses, in early banking systems, in retirement planning, in the rise of mutual funds and index funds. The culture around investing has changed dramatically. Decades ago, investing was often seen as something for wealthy people, institutions, and professionals. You might need a broker. You might need large amounts of money. You might need access. Today, a beginner can open an investing app in minutes. They can buy fractional shares. They can learn from videos. They can read company reports online. They can invest in broad funds with small amounts. Access has improved, but access without discipline can be dangerous. Because when investing becomes easy, impulsive investing becomes easy too. You can buy because you are bored. You can sell because you are scared. You can chase a trend because everyone online is talking about it. You can confuse entertainment with education. You can mistake a viral post for financial wisdom. That is why a wealth system matters. A system protects you from your mood. It protects you from hype. It protects you from panic. It gives your money a job before the world tries to give it one. Here is what a beginner wealth system can look like. First, decide your financial order. Before investing heavily, cover essentials: food, rent, transport, basic bills, insurance if needed. Then build a starter emergency fund. Then attack dangerous debt. Then begin investing consistently. Then increase the amount as your income and stability grow. Second, automate what you can. Automation is powerful because it removes emotion. If money moves automatically into savings or investments after payday, you are less likely to spend it accidentally. This is sometimes called paying yourself first. It means your future gets paid before your impulses. Third, create rules. Rules make decisions easier. For example, I do not invest money I need within the next year. I do not buy something just because it is trending. I do not use high-interest debt to invest. I do not panic sell based on one bad headline. I review my money once a week. I increase my investing amount when my income rises. These rules may sound simple, but simple rules repeated over years can beat complicated plans that are never followed. Fourth, learn the difference between income and wealth. Income is money you earn. Wealth is money you keep and grow. Some people earn a lot and stay broke because they spend everything. Some people earn modest incomes but build wealth because they control spending, avoid bad debt, and invest consistently. This is one of the biggest mindset shifts in personal finance. A high income can help, but it does not guarantee wealth. Without money skills, more income can simply create more spending. This is called lifestyle inflation. Lifestyle inflation happens when your spending rises every time your income rises. You get a raise, so you upgrade everything. Better phone, better clothes, better apartment, better car, more restaurants, more travel, more subscriptions, more financial pressure. Then somehow, even with more income, you still feel broke. A wealth system prevents this. It says, when income rises, my future also gets a raise. That means savings increase, debt payoff increases, investing increases, not just lifestyle spending. This is how beginners slowly become investors, not by pretending to be rich, but by building habits that create real financial strength. Now let's bring the 5 skills together. Skill 1. Cash flow control. Know where your money goes. Skill 2. Saving before investing. Build protection so emergencies do not force bad decisions. Skill 3. Debt control. Understand interest before trying to earn returns. Skill 4. Risk understanding. Know what can go wrong before you invest. Skill 5. Building a wealth system. Turn good decisions into repeatable habits. These 5 skills are not separate. They connect. Cash flow creates surplus. Surplus creates savings. Savings creates safety. Safety helps you handle risk. Debt control protects your progress. Risk understanding protects your mind. A wealth system turns all of it into a lifestyle. This is why investing should not be treated like a random activity. Investing is part of a financial life. And if the life around the investment is chaotic, the investment journey becomes chaotic too. Let's make this practical. Suppose a beginner earns money every month and wants to invest. They are excited. They have watched videos. They see people online talking about stocks, ETFs, real estate, crypto, and AI companies. Markets are moving. Headlines are everywhere. Some people are warning about inflation. Some are talking about interest rates. Some are excited about new technology. Some are afraid of recession. Some are predicting a boom. Some are predicting a crash. The beginner feels pressure. They think, if I do not invest now, I will miss out. But before they rush, they pause. They track their spending for 30 days. They discover that they can free up a small amount every month by cutting waste, not by destroying their life. They build a starter emergency fund. They list their debts and make a payoff plan. They learn that risky assets can rise and fall. They decide which money is short-term and which money is long-term. They create a simple rule. I will invest consistently, calmly, and only with money that belongs to my future. That person is no longer just chasing investment returns. That person is becoming an investor. There is a difference. A person who buys an asset once is not automatically an investor. A real investor has a process. A real investor has patience. A real investor understands risk. A real investor does not need every decision to be exciting. A real investor knows that wealth is built by surviving long enough for good decisions to compound. And this is where history becomes encouraging. Many of the great wealth-building stories were not built overnight. The stock market itself has survived wars, recessions, inflation, crashes, bubbles, bank failures, political shocks, oil shocks, technology revolutions, and global uncertainty. The culture of investing has moved from exclusive clubs and paper certificates to online platforms and instant access. But through every era, one truth stayed the same. People who manage money will have a better chance of investing well. Because when you manage money well, you can stay in the game. And staying in the game matters. You do not need to be perfect. You do not need to know every financial term. You do not need to predict the next market move. You do not need to copy every influencer. You do not need to become rich next month. You need a foundation. Because the strongest buildings are not strong because of the paint. They are strong because of the foundation underneath. Your investments are the visible part. Your money skills are the foundation. And if the foundation is weak, even a good investment can become stressful. But if the foundation is strong, you can approach investing with calm, clarity, and confidence. That is the real goal of this episode. Not to scare you away from investing, but to prepare you for it. Investing is one of the most powerful wealth-building tools available to ordinary people. It allows you to own pieces of businesses. It allows your money to participate in growth. It allows time and compounding to work in your favor. It can help you build freedom, security, and opportunity. But investing works best when it is built on personal finance discipline. So before you invest, ask yourself 5 questions. Do I know where my money goes? Do I have savings for emergencies? Do I understand my debt? Do I understand the risks I am taking? Do I have a system I can repeat for years? If the answer is no, do not feel embarrassed. That is not failure. That is your starting point. Every strong investor had to learn the basics. Every financially confident person started somewhere. The goal is not to look rich. The goal is to become financially strong. And financial strength begins with small, repeated decisions. Track your money. Save something. Pay attention to interest. Respect risk. Build a system. Then invest. Not with panic. Not with hype. Not because someone online made you feel late. Invest because your foundation is ready. Invest because your money has a plan. Invest because you understand the game you are entering. Invest because you are prepared to think long term. That is how beginners grow. That is how confidence is built. That is how financial education turns into financial progress. And that is how money stops being a source of confusion and starts becoming a tool. So if you are at the beginning of your financial journey, remember this. You do not become wealthy by rushing. You become wealthy by preparing, learning, acting consistently, and giving your decisions time to compound. The world will always have headlines. Markets will always move. Rates will change. Inflation will rise and fall. Trends will come and go. People will shout predictions. But your foundation is what keeps you steady. Master these 5 money skills before you invest, and you will not just be buying assets. You will be building the kind of financial character that can hold them. And that is where real wealth begins. If this video helped you understand the foundation you need before investing, subscribe to Capital Academy for more beginner-friendly lessons on money, investing, debt, assets, compound interest, and wealth building. In this same series, please check out the next video episodes on your screen. They are the secret guides and blueprints no one else teaches you in your investment journey. And remember, before you chase returns, build your foundation. Because the best investment strategy begins before you invest a single dollar.